Hey folks, Dave Nadig here, financial futurist at VettaFi. Went on a great hike with Elisabeth Kashner. She's the director of ETF Research and Analytics at FactSet Data Systems. Took a stroll in Tilden Park in California and then sat down. We have a pretty broad conversation. We talk about ETF ownership and what you need to know about that. We talk about heartbeat trading. We talk about tax deferral. We talk about capital markets issue. This is what happens when you get two ETF nerds just having a conversation. I hope you enjoy it. I know I did. Cheers. What do you think is interesting right now, not just in ETFs, but markets, indexing, data, flows, like what people might be missing?
So, I think just taking an ETF lens, the landscape right now is so crowded that, clients get confused and asset managers really have to press their competitive advantage everywhere that they can. And so that means really digging around in a lot of different spots.
But so is it more than just cost? Because that's where everybody says like, oh, asset managers have to compete. Cost. That seems like a lot of what it's been for the last 25 years.
Well, I think that's true, but cost is a pretty broad topic. And so it's probably not just the expense ratio that you were thinking. So
start at the trading floor. So
what
are you seeing in terms of like new product launches, flows, spreads, how people are getting executions? What are you seeing that's interesting?
New product launches are apace. They're no longer at the breakneck speed that we saw in 2020 and 2021, but they're kind of marching along, and we are seeing the continuation of the old line mutual fund firms starting to stick their toes into the ETF world. And some of them are really working hard to educate themselves about what it takes to succeed in the ETF world. And some of them are very confident in their product and their brand without necessarily having done the work to warrant that confidence. So
is some of that just what audiences they're going after? Because there's a difference between products that are really naturally targeted at the Schwab person who has a $250,000 portfolio and is trading their own account, and the big RIA that's got effectively a model portfolio. They're doing giant allocations and swings. Obviously, very different needs in the product space, very different needs in the trading space.
Well, it's so interesting that you mentioned Schwab in there because Schwab is such a big house and they have so many different lines of businesses that they're really able to take advantage of internal synergies and quite often funnel a lot of Schwab brokerage clients or Schwab wealth associates into Schwab products to the extent that some of their lesser known names, you might see something like 75% of the asset base all coming from in-house.
Sure, because
right?
They've also got like the intelligent portfolios which use those products.
For sure.
And there's lots of reasons. Sure. I mean, I think I've written about it 100 times. I've been a Schwab customer since the 80s. And yeah, they promote all that stuff on the front page just like everybody else promotes all of their own stuff on that front page.
Absolutely. So you also mentioned model portfolios, right? If you're taking on that fiduciary responsibility of building someone's entire portfolio for them, and you're looking to select ETFs within a competitive landscape, I think it's really important to understand who are the major owners of all of the products that you're looking at. If you find an instance of affiliated ownership, like we do at FactSet, because we take a look at 13F data and we're able to trace the activities of all institutional owners, anybody who's big enough to have to report a position, we can kind of see who's holding what. So you can use that information, especially if you're careful to data line it and use FactSet shares outstanding, right? If you really do it properly, you can get a sort of more competitive view of what's been hunted and killed versus what's been fed on a plate.
That issue of who owns what seems to be like one of these just perennial problems with the ETF industry that nobody's really cracked. Are there any surprises when you start looking at that data? I mean, is this a bigger problem than people may realize, that a lot of the data we think of as being AUM is actually kind of double counted and reinvested?
Really, I think what you're saying is that if you roll up to the entity level, right, and businesses have lots of subsidiaries and interlocking ownership, but FactSet entity data allows us to roll up majority stakes so that you can see really all of the different business names and kind of crawl up the ladder. And if you look that way, sometimes you might be really surprised at how big the affiliated stake is.
And so that has the effect of what? Basically just over-exaggerating the popularity of individual products or individual issuers, and that leads to perhaps skewed decision-making.
it can lead to skewed decision making. If you're a fiduciary and you're using AUM as a sort of, well, everybody else likes this fund, so I guess I should too, then I think getting a sense of the AUM that was won on the competitive battlefield versus the AUM that was solicited in-house is a useful thing to know.
Right, the different stories, right? I mean, conversions is another issue. We've had just a raft of conversions. A lot of them have been a little bit niche. They've been, products that didn't get used in retirement plans. A lot of the DFA products sort of fit that mold as well. Have you noticed any quirks in that process? I mean, a lot of those firms all of a sudden are major players in the ETF industry and were not players in the ETF industry 18 months ago.
Yeah, I mean, the two big names there are Dimensional and Cap Group. And Dimensional, I think, really did a phenomenal job of, to hear them tell it. They say they responded to their client base that was clamoring for their products in an ETF format. I don't need to speak for Dimensional. They do an awesome job of speaking for themselves. But I can say when I interviewed them regarding this topic, that is what they told me. But, Dimensional also has, coming back to cost, they have a real cost advantage. They're offering portfolios, really solid, almost total market exposure in an active format. Some of them for 19 basis points. Even Cap Group is not competing with that on cost. And so some of the products that have converted, that have, brought in millions or tens of millions of dollars and are still sitting at 40, 50, 60, 70, 80 basis points, let's just say that conversion is not necessarily the answer to solving your flows problem. We've already seen one converted ETF close.
Right.
And I wouldn't be surprised, say, 12 to 18 months from now if that list was a little bit longer.
Yeah, I mean, certainly there's no magic bullet on flows, that's for sure. It does seem like the model portfolio business is driving much more of it than it used to. Although when we were hiking here, you pointed out that, those flows aren't necessarily going into the products we might expect. Even though there's model portfolios, you would expect that means, total market funds, broad aggregate bond exposure, maybe some, very broad commodities type of alternatives exposure, and that would be about it. But that's not where the flows have gone.
Their flows are going there a lot less than they had in really the preceding decade. A model portfolio operator is operating in a competitive environment, the same as financial advisors, the same as asset managers, the same as data providers, right? Even journalists.
Yeah.
And, in this environment, if you're going to compete on cost, you're going to just wind up at Vanguard, right? You're going to have a dirt cheap, very simple 4-fund portfolio from Vanguard that's going to be not that different from their life strategy mutual funds. And it's going to be really functional. And for many investors, that is probably an excellent place to wind up. But if you are in the business of selling a model portfolio, you have to have a story with your model portfolio. Right? And when you have a story, having products that themselves also have a story just furthers your cause.
Right.
So I'm not surprised that a lot of model portfolios are putting clients into nichier and more expensive and frankly sometimes riskier products.
Well, I mean, many advisors have told me they can't sell a one-ticker portfolio, right? That's not why their clients are coming to them. They're expecting some level of sophistication in the investment approach. And if you say, I'm just putting you in this moderate balanced fund, that doesn't necessarily ring the bell. So what ends up happening is they end up recreating that by using smaller pieces. Do you think that there will ever be a shift towards true mass retail adoption? Because it still feels like we have a lot of newbies coming into the ETF space every week.
We most certainly do have newbies coming into the ETF space. And Dave, some of them are retail and some of them are advisors, right? We were chatting a little bit earlier that, what is the one thing that we wish we could tell to the new advisors straight off the bat? And I think I would have to start these days with, please don't use a market order.
Don't use a market order. Like the one piece of advice I think we've been giving for a decade about ETFs that I think will never go out of style. Which is ironic because there's so many ETFs now that you can just look at on screen and they're trading a penny wide all day. And some of them are like niche corner active strategies that have just gotten very popular. And then there's other funds that come from name brand houses that are trading a percent wide. And I think a lot of investors don't necessarily know out of the gate to be checking that, to be really looking at that.
Right. Well, and frankly, a lot of asset managers don't know that they need to attend to capital markets issues. You know, when I have people who are entering the ETF space, sometimes call me up and you know, wonder why FactSet has given their fund a poor score on liquidity when their whole portfolio is, you know, consists of U.S. equities that are not that hard to trade.
Right.
You know, I might say, like, you really need to do some work on capital markets and you need to educate your clients, because here's the thing. You could have a reasonably solid strategy that would fit fine in a portfolio, but if your primary adopters are going out there and they're paying, you know, premia of 50 basis points or 100 or 150 because they're just chasing a market order because they've never had to learn how to trade, and now they're you know, what's a limit order, you know, what's an ETF liquidity provider, what's trade away, you know, it's going to leave a bad taste in their mouths, because a product that is going to look really successful on paper is going to perform much less well for their clients because they overpaid for it. Needlessly so.
Yeah, and that's, you know, one of the reasons why mutual funds will probably never go away is you don't have any of those issues. I mean, to heck with the 401k market being a reason the mutual funds won't go away. There is something about end-of-day NAV trading which makes people very comfortable with these things. I mean, that sort of inevitably brings us to talking about things like share classes, right? The patents are in the middle of expiring. I think the first one's already expired in May. What's your over-under? Are we going to get the rash of people doing Me Too, or do you think this is just nobody's going to care?
Dave, nobody does regulations like you do regulations. You are the master here. So I'm not going to tread too much on your turf, but I think we have to talk about 6C11. Right, and if you really like dig into 6C11, and if you talk to some of the people at Vanguard about it, like, they were very happy with the way it came out because it exempted ETFs as a share class from the streamlined launch process that the ETF rule, aka 6C11, afforded. So if you're an asset manager and you're looking to launch an ETF as a share class, you still have a long road.
You got to go through the whole thing.
Yeah, a lot of paperwork. And then you have to ask yourself, you know, why do I want to be in an ETF format? And there can be some good answers to that. It generally comes down to cost, right? With the lower record keeping and the easier portfolio management that comes with the ETF structure because of the in-kind creation redemption process. You know, it really is cheaper to run. And because of in-kind creation redemption, you can create a lot of tax efficiencies that, you know, mean that there's many fewer or no pass-through capital gains for the year, and clients don't like pass-through capital gains, never have. So those would be some good reasons, but, you know, you have to kind of figure out how much money can you really save your clients, and is it worth the headache? And, you know, also, is it worth the capital markets charges, which, you know, even if you get them super efficient, they're not zero.
None of it's zero, right? The legal fees to do it, like the board meetings get more complicated. I mean, it's not free to just switch on the share class structure, and nobody's done it but Vanguard yet. I know that there's some folks filing for it. I'm very skeptical. I'm trying to imagine the Venn diagram overlap of has a brilliant strategy that's in a traditional mutual fund wrapper, but not so brilliant that they want to clone it, like the Magellan, right? Like Magellan was the one we used to talk about all the time. Now there's a Magellan ETF. The performance goes like this, right? I mean, it's basically the same fund. PIMCO, the same thing. So like, what's left that would have so much draw that you would go through the hassle? And I can't come up with many funds.
I guess I'm coming at it from a slightly different angle in that, you know, we just talked about the capital gains taxes and how nobody likes them. Truth is that there's been a business out there for years called Reflow that will kind of manufacture an in-kind redemption for a mutual fund that can wash out a lot of those unrealized gains.
But it doesn't get used that much, does it?
Certainly not as much as the Reflow people had imagined, given the value that you know it could present, and you know the number of clients who seem to really truly dislike annual pass-through capital gains. But you know, given that that solution exists, it kind of narrows the reason that you might actually want to take on all of the burden of what it takes to launch and maintain as a share class.
Right, if you were just doing it for the tax reason, you could use reflow. And frankly, you can do, like, there's nothing legally stopping a 40 Act fund from doing the in-kind creation redemption. They're just not set up to do it most of the time.
And their clients would be a little bamboozled, I think.
Yeah, exactly. It's just sort of, it's as much a cultural norm as it is anything else. It's just not how those businesses work. I'd be remiss to not mention that we've just been on this incredible, beautiful hike in Tilden Park in California, and you're wearing a shirt that says, "I'm inspired, brave, and determined." I'm guessing there's a story behind that. What's the story behind your shirt?
So thanks for asking, Dave. You see the orange letters IBD? Those, unfortunately, are short also for inflammatory bowel disease, Crohn's and colitis. I've recently stepped onto the board of the Northern California Crohn's and Colitis Foundation. Yeah, it's a cause that I really believe in, and it's just touched my life and my family's life in a lot of ways, and I'm just really excited to get out there and talk about the foundation. So it seems so fitting, going on a walk with you, my longtime friend, that I get to wear my values on my shirt.
I love it. Well, tell me, I want to hear one more thing about it. Like, what is it that the foundation's doing that you're excited about or is giving you hope?
So much hope, Dave. Virtually all of the major research advances in treating Crohn's and colitis have been fully or partially funded by the Crohn's and Colitis Foundation. The treatment pipeline right now is extraordinary. There's just so many different avenues of research when it comes to genome and nutrition and environmental triggers and various disease pathways. And so, Crohn's disease used to be incredibly debilitating. We've got much better treatments than we did a couple decades ago. And, for people who are diagnosed as children and are looking to live with this disease for decades to come, we really need this robust pipeline.
Well, thank you for sharing about that. One thing that people may know you from, of all of the work that you've done over the decades that it's not quite decades, over the time that I've known you, is your work on heartbeat trades. I think you invented that phrase. You certainly wrote the definitive article talking about what they are, how they work. For folks who aren't familiar, this is sort of that process of doing the in-kind redemption that washes out capital gains, but a little bit more at the request of the issuer as opposed to just natural in and out flow. And that's a bit controversial. What's the news there? Has there been any big movement in that world?
Well, for a little while, working on the legislation that had been known as Build Back Better and turned into the Inflation Reduction Act, there was some talk about going after the ETF creation redemption in-kind process.
The whole thing.
The whole thing. Yeah. For a while, it was coming out of Senator Ron Wyden's office, Senate Finance Committee. That really never made it off the floor, but I have to say at that time, I wondered if they might find a slightly better sell in asking the IRS to sort of look more carefully and differentiate between an affiliated trade and an unaffiliated trade. So technically, a heartbeat trade is not affiliated.
Because you're trading, the fund is trading with a third party, a market maker.
There's an investment bank, a BD, that is putting its own capital into the fund for a period of 24, 48, 72 hours, and then withdrawing its own capital.
In kind, which was the key, right?
Partially in kind. Anything that's coming out that has unrealized gains to it, that will come out in kind. Others, the portfolio manager might find more advantageous to sell outright and capture a loss, right? This is generally done on the occasion of a portfolio imbalance, especially ones that are infrequent, where if the PM didn't have naturally occurring redemptions on the particular day that they were needed, would sort of be forced by the index recomposition
to have to make a big trade,
right? And so the jig would be up at that point. But, they have cooperation from some of their unaffiliated but business relationship capital markets partners who come in and put their own capital at risk and do get some trading opportunity out of it as well. But it's very different from a natural redemption that, say, a retail investor might be selling a large position to put a down payment on a house or send a kid to college, right? Or a model portfolio might be generating that, okay, it's time to swap out of this and into this, right? All of those are really done at the behest of the ultimate buyer and seller. They're not they're not generated by internal tax
Right.
management
No
needs.
portfolio manager is calling up and saying, hey, I need to move X.
I
It's
mean,
going the other way.
So just to
Right.
be clear, I'm not convinced that the PM is actually calling the BD and saying this is what I need to do.
But there's a
I think
process in place.
I think they're circumspect about how they communicate about it because everybody wants to stay within the letter of the law.
Right. And
everybody.
It's been that weird thing where, I mean, I don't want to mischaracterize your opinions, but having read your work, you're not arguing for getting rid of creation redemption in kind. You were saying this starts bordering on something that feels a little gross, and maybe we should just think about enforcing the rules we have there a little bit more effectively. Is that an accurate way of?
I would say if the concern is about tax fairness,
Right.
the function of the heartbeat trade is to take a high turnover portfolio and give it the tax profile of a low portfolio turnover. And I wonder what would happen if that fairness conversation got a little bit more front and center.
Yeah. Do you have a sense for how economic it is? Because when it comes to Congress working on this or the IRS working on it, the question is just going to be, well, how much money is at stake here? Like, what is do we know what the implied tax difference in collections would be if you just turned off heartbeat trading?
You know, Bloomberg ran an estimate of this in, what was it, 2018?
Yeah, it was years ago.
It was 2019.
Yeah.
And they had it kind of easily in the billions. You know, I do want to be clear, just in case our listeners need a little differentiation. The heartbeat trade is not tax avoidance, it's tax deferral.
Right. You're basically just saying you're going to pay this later, you're not going to pay it now.
Yeah,
right.
Exactly. Because when a portfolio manager does realize a capital gain in the portfolio, that has to be distributed to the holders at the end of the year, and the dollar amount per share that's distributed, the NAV value drops by that much. And so the price that you would sell it at the day after the distribution is lower. So with the ETF, the NAV just keeps increasing, assuming rising markets and successful
investing. So depending
investing.
on where you bought it, you're accumulating that future capital gain because you're going to get that lowering of the basis over and over.
Right. Now, you know, if your goal with your money is to drop dead and hand it to your heirs and have it all free of, you know, have a big basis reset at the time of your death, then, you know, an ETF that's never made a capital gains distribution ever is the perfect
Beautiful,
thing.
Yeah.
Congratulations on dropping dead.
Yeah. Well, no, but you were mentioning this on the hike before. It's always an implied bet, right? The whole issue of tax deferral, it always sounds like a net positive, always to pay taxes later. That implies that when you have to pay those taxes, maybe you didn't just have a giant windfall and now you're in the top tax bracket.
Right. Or that tax rates won't change.
Right, which I think is a very large guess. I don't think that's likely in my lifetime, that we're not going to mess with the tax code. I think, of course, we're going to mess with the tax code.
Right, and in which direction, for who, like that's an unknown. But I do think, you know, we were very much in agreement that tax deferral might be a winning strategy, but it definitely has some risks to it.
Yeah, and I think I always in my head, for whatever reason, just maybe because I started there, I always have the young retirement saver in my head because I started in the 401k business. And so when I think of...
And because you have some young adults
and I
entering
have young
the
adults who are
workforce.
putting their money in their 401k for the first time.
Congratulations.
In those cases, it's really obvious. If you're 25 years old and you're just getting started and you're putting money away, yes, of course you're going to use the tax-deferred vehicle to do that, not the least of which because they're going to probably give you extra money, right? So I think, but that gets baked into tax deferral, and it's not always just the best thing. You're such a good dog. Well, this has been great. Thank you, Elisabeth.
Yeah, this has been.